In today's video, I'm going to take you through the 5 mistakes I made as a beginner on trading 2 and 2 that lost me money, or things I did that stopped me from making more money. So if you're using trading 2 and 2, you might be making these same mistakes too without even realizing it, and there could be changes you can make right now to improve your portfolio or to stop the bleeding. I'll also take you through number 4, which is a much more common mistake than I realized, and I think most people may be making. And if you are, this can help you to start make more money right now by the end of the video. So let's get started. Now, ever since I started this channel about 4 years ago, I told you that I would show you my journey, the good, the bad, and the ugly, and most YouTubers show you only the profits, and I'm here to show you the losses as well, and the real journey of investing and trying to build a 100k trading 2 and 2 portfolio. So these mistakes I'm about to show you are ones I've genuinely made, and although I think I'm a seasoned investor, I can also be a bit dumb at times. So if you appreciate someone showing a real journey and making the mistakes so you don't have to, then please consider liking the video and subscribing to the channel. But let's jump right in. So the first mistake that I made that you'll grill me for was that initially I invested in the invest section on the platform. Now some of you might be thinking, well, that makes sense. You want to invest, so you invest in the invest section. Now, this was short-lived, but for a little while I had started buying my shares, building my portfolio, and receiving my dividends all outside of a tax wrapper. Because the mistake, of course, is that the invest section has no protection from tax. So everything that you invest in here would either immediately or eventually result in getting taxed for your cash interest or capital gains or dividend tax. Now, there is a reason to invest in this section, otherwise trading 2 and 2 wouldn't have it. But typically it would only be once you've maxed out your stocks ISA. Because as you know, the stocks ISA section is your tax wrapper, and everything you invest in there is safe from tax on interest, capital gains, and dividend income. And the general rule of thumb is to build your portfolio there, and any amount you want to invest over and above your £20,000 annual ISA allowance can be invested in the invest section. So I wasn't there too long, but in the beginning I did have to sell and rebuy my portfolio in the ISA section. So correcting that mistake stopped me losing money on dividends and interest to tax, but also will save me down the line on any capital gains tax. Then my second mistake was one that actually stopped me making more money. And interestingly, it involved making more money by taking money out of my ISA, and I'll tell you why. Now, when I started with my ISA, I essentially put all of my extra money that I didn't need, my non-essential cash savings, into my cash ISA. And like I said, of course it's to protect you from interest tax on cash, and it's actually a brilliant long-term method for your cash savings, but it doesn't mean it's the only solution or the best solution for your money. Right now, trading 2 and 2 is paying you 3.6% interest on your cash. That's not bad. But out there in the marketplace, there are accounts and methods that pay you much more and nearly double that rate. Now, if you're a basic rate taxpayer, you get a £1,000 tax-free interest allowance, and if you're higher rate, that goes to £500, and if you're additional rate band, then unfortunately it's zero. But it means that you can actually move all or a portion of your cash to higher interest rate accounts as long as you're still under that limit and make more interest on it tax-free. So for me, instead of paying all of my cash into the cash ISA, I found accounts paying between 6.5 to 7.1% interest, which I did a video on here, and I did some maths and moved a portion of my cash to a Lloyd's account that was paying 6.5% interest on that portion of my cash. Now, maybe you want to keep it simple, but if you want to maximize all of your hard-earned pounds, this could be an option to make you more money overall. The next one is a personal preference of mine. When I started, I was doing a lot of stock picking. Specifically, I was investing individually in the top tech stocks like Alphabet, Meta, Nvidia, Tesla, Broadcom, Amazon, and more. The problem with that, for me, is it was impossible to keep up with all of the news and earnings reports and stock movements of so many different companies on top of a job and normal life. And when there was a dip in a stock or the market, I was trying to divvy up my money and pick which ones I was going to allocate to based on where I thought the market was going or whether each stock was a good buy opportunity or not. It meant I was all over the place and frankly missing opportunities or picking the wrong time to put money in each stock. Now, in the last year, tech stocks have done well, and overall I've made good returns on these, but I decided that I wanted to simplify my investing but also make sure I don't miss out on other stocks that aren't tech and also other areas of the world as well. So in the last few weeks, I've been taking the overall profits from these stocks and I have sold them off and reinvested that money into the Vanguard FTSE All World ETF or VWRL. Now, you could argue this would make more money or less money over the long term, but I think this will greatly improve my investing strategy and I don't have to worry about the rise and fall of individual growth stocks. I do have a large dividend portfolio with individual stocks, but we'll touch on that in another video. Plus, this ETF pays a bit more in dividends overall, and studies have shown that over the long term, ETFs like the S&P 500 have outperformed stock picking for most individuals and institutional investors, so personally I think it will make me more money in the long run. Now, we're talking a lot about tax and how to save it, and there is a way that you can actually get tax back and boost your investments by 25% or more. So this year, I used InvestEngine to open a SIPP or a self-invested personal pension. Now, if you've maxed out your work pension or you work for yourself, or if you want to take more control of your pension by investing it yourself and choosing where to put your money for the long term, then a SIPP helps you to do that. And the best part is you get at least a 25% boost from HMRC that they pay directly into your InvestEngine account. So here is mine with about £290 invested, and here it shows the £75 that HMRC will be adding to it for free. Trading 212 doesn't offer this, so I've used InvestEngine. Now, I have a whole video on this with more info, but if you want to control your personal pension, take advantage of the extra 25% and the compound growth that comes with it, or just to invest or save here in an ISA, you can use our link in the description, and if you deposit £100 or more, you will get a free bonus of between £20 and £100 to start your journey. That's a free £20 to £100 return straight away. Now, this is an affiliate link, so you will get a bonus and I will get something as well. If you want to check it out, the link is below. So the next mistake I made is one that literally lost me money, and it's a mistake that is completely avoidable and one that I think personally a lot of people using Trading 212 are making right now, this very second, maybe even you. And that mistake that I made was investing in the wrong versions of ETFs. Now, what does that even mean? Well, if you don't know, Trading 212 is free, but that doesn't mean there are no fees, and one of those fees is an FX or foreign exchange fee. And if you're investing in American stocks, for example, one way or another, you will have to pay the FX fee of 0.15%. Like this screen here, you can see the fee before you buy. And the mistake I made was that you will also pay that FX fee on ETFs if you're not using the right ETF. So let's say you're watching a big American YouTuber and they are talking about their Vanguard S&P 500 stock VOO. So you go and invest in it too. And you are now paying the FX fee and eroding your money, and over the years, when you compound this fee, it can add up to a lot. But many people won't know that there is almost always a UK equivalent of most ETFs that invest in pounds and that you don't pay the FX fee on. So for the Vanguard S&P 500, this is VUSA instead of VOO, and you get the same returns without the fee. For me, I was investing in QYLD, my 11% dividend ETF, when there was a perfectly good UK equivalent, QYLP. Now, I didn't know about this, and it doesn't charge the FX fee, so I've changed over, and now I can invest in it without the extra fees. So double check your portfolio and make sure you're investing in the right version of these ETFs, and this can literally stop you losing money on these in fees right away. And my last mistake that I was in for a while was not making use of the pies and automatic investing. I was just winging it, buying stocks on a whim, and right now in the market is a perfect example. Out there in the world right now, we have wars and conflicts in Iran and other areas, and we have the closing of the Strait of Hormuz that has caused oil prices to skyrocket and stocks and markets around the world to drop drastically. For me personally, this is when I like to invest and buy up stocks and ETFs at discount prices. The problem is that we don't know when the bottom will be, and the news is changing every day, and no one frankly knows what will happen and when this conflict or war will end and the strait will reopen. Often investors will invest on the news, then the market drops lower and invest more. Then a tweet comes out saying the war is over for the market to jump up, only for it to not be the case and the market drops some more, and eventually you run out of money to invest any further as the markets drop more and we miss out. Instead of that, I've been using the pie feature on Trading 212 that allows you to set to invest automatically. So for me, I deposit my full amount to invest, and I set to invest for me automatically every single day. Right now it's mostly on my old world ETF, so no matter what happens up or down, I don't have to guess and allocate my funds. They invest all the way down and hopefully all the way back up, and it automatically allocates my money. By doing this over the long term, I do think it will bring me better returns and even out my buying price. And by using the pies, you can select exactly which stocks and ETFs you want your account to invest in automatically and when. There will always be something happening in the markets, if it's wars now or interest rates or anything else, so I'd really recommend checking out this feature to simplify your life and also to invest with less emotion and perhaps more structure for the long term. But guys, that is it for today's video. I hope you enjoyed hearing about my mistakes and maybe some of it helps you to be a better investor. Remember to like the video and subscribe, and check out your bonus for InvestEngine below. YouTube thinks you'll like this video next, and I'll see you next time as always on Casual Cash. Cheers.